Welcome back to The Explainer. Look, we are looking at a market right now that has been fundamentally ruptured. I mean, you've seen the news, you've definitely felt it at the gas station, but today we are going to look way past the surface level panic. We're going to dig into the raw data and the actual market mechanics to understand exactly how professional desks are trading the closure of the Strait of Hormuz. Because believe me, they aren't just sitting around complaining about prices. Okay, so let's just dive right into the absolute cognitive dissonance of the moment. This is the exact question everyone is asking right now. We have record high domestic oil production in the US, right? The pipelines are flowing. So why on earth is the average driver paying $5 a gallon? To answer this, we're going to explore the hidden macroeconomic mechanics using what I like to call the iceberg model. We absolutely have to separate the visible retail pain, the stuff above the water, from the professional market alpha that is lurking deep below the surface. Because the stark reality of the Operation Epic Fury fallout is a staggering $1.32 national average surge in retail gasoline. And to be clear, this isn't just a temporary fluctuation. It's not your normal, seasonal summer driving spike. What this number actually represents is the establishment of a permanent Hormuz premium floor. It's basically a structural addition of roughly 30 to 35 bucks per barrel to global prices. And the kicker is it persists even when there are whispers of a fragile ceasefire. The market is pricing in the new reality. So, how do we unpack all this? Well, here's our roadmap for navigating the crisis. We'll start with the Hormuz premium math, then we'll measure the global asymmetry, and we'll look at tankers as leading signals. After that, we'll dive into the technicals. WTI Brent arbitrage, the retail mean reversion trap, and finally, professional derivative strategies. All right, Section 1, the Hormuz premium math. Let's break down exactly how a conflict thousands of miles away in the Persian Gulf directly drains your discretionary spending right here at home. Now, what's really fascinating here is how global oil integration acts as an inflation transmitter. Consider these numbers. You have the national average up $1.30, but then look at the high-cost regions. Oregon has pushed well past the $5 mark to $5.29. The U.S. might be, quote-unquote, energy independent on paper, pumping crude at near-peak capacity, but that crude is priced on a global, heavily integrated market. It's all one giant pool. So when 20 million barrels a day get bottled up in the Middle East, the marginal cost for the entire world goes up, and that transmits directly and painfully to your local gas station. But wait, it's not just the raw cost of crude. This $1.42 represents the 3-to-1 crack spread at New York Harbor in March 2026. Now, normally the 5-year historical average for the spread is just 68 cents, literally half of that. The crack spread basically measures the profit margin refiners make by turning raw crude into usable products like diesel and gasoline. And because the Strait of Hormuz closure disrupted 5.5 million barrels a day of refined products, it triggered this massive supply chain bullwhip effect. Refiners are scrambling, their margins are absolutely exploding, and all that extra cost, that gets passed straight to the consumer. Which brings us to Section 2, measuring the global asymmetry. While the U.S. definitely feels the pinch of the pump, we really need to zoom out and measure the drastic regional disparities this blockade has created. Because this perfectly illustrates that the U.S. is merely the second most impacted region fighting inflation. We've got a 28-day domestic supply buffer to absorb that initial shock. But think about Southeast and East Asia for a second, specifically Japan and South Korea. They are staring down a catastrophic physical energy vacuum. Japan relies on the Middle East for 90% of its oil. 90%. So they aren't just dealing with higher prices, they are facing critical, absolute shortages that literally threaten to shut down their entire electrical grid and industrial base. It's a completely different level of crisis. But here is the brutal truth beneath the surface. The fertilizer LNG paradox. You see, 1/3 of the world's fertilizer production and 20% of global LNG trade transit the strait. When Qatar's Ras Laffan facility declared force majeure, ammonia and urea production completely paralyzed. So the true pain of this crisis isn't just $5 gas. It is a looming, massive global grocery supply emergency. As fertilizer costs spike 35%, crop yields fall, and we are looking at a projected 40 to 120% surge in grocery prices heading into 2027. This is a multi-layered economic shock that goes way beyond the energy sector. Okay, moving on to Section 3, tankers as leading signals. Let's see how the physical vessels actually move in the oil translate into actionable market intelligence. $770,000. That staggering number is the record-breaking daily charter rate for a very large crude carrier. specifically the VLCC Colomos, traveling from the Red Sea to India. Just to give you some context, pre-crisis, you might see rates around 40 to 200 grand a day, but $770,000 a day? That proves that extreme freight rates act as a massive demand destruction mechanism. Think about it. When the cost of shipping suddenly makes up 20% of the entire value of the oil sitting on that boat, refiners simply stop buying. They cut production. And that right there is a massive signal for traders. And professional traders track these floating storage rates as an absolute leading indicator. We actually saw VLCCs being chartered at $500,000 a day, just to sit there, literally just acting as floating storage to circumvent production risks. When oil on water hits 25% of global stocks, it means the global maritime buffer is completely filled up. The whole system is saturated. And historically, when that floating storage peaks, a recalibration of the war risk premium, and ultimately a peak in the absolute price of oil, is absolutely inevitable. Let's dive deeper into the mechanics. Section 4, WTI Brent Spread Arbitrage. We are now entering the deep waters of technical trading to see exactly how professional desks isolate this geopolitical choke point. So, the absolutely crucial point here is this unprecedented $25 spread. Under normal conditions, the spread between US-based WTI crude and international Brent crude is super tight, usually just $2 to $5. But during the 2026 crisis, it blew all the way out to $25. This mathematically isolates the geopolitical risk premium. Brent crude represents seaborne oil directly exposed to the drones and the mines in the Strait of Hormuz. WTI represents landlocked, physically insulated North American oil. Trading this spread is exactly how professionals harvest alpha, without taking on pure directional risk of just guessing if oil goes up or down. And alongside the spread, we have to talk about backwardation. During the peak of the panic, the front-month Brent contract was trading $16 higher than the very next month. I mean, that is a massive scramble for supply. Refiners are paying literally any price for immediate delivery just to keep the lights on, while the futures market is basically betting that things will calm down eventually. Understanding backwardation is so vital because it completely exposes the vulnerability of buy-and-hold retail commodity ETFs. Those funds often just bleed value when they have to constantly roll these heavily skewed contracts over and over. Which leads us perfectly into Section 5, the retail mean reversion trap. This brings us to the psychological divide in the market and how retail investors frequently become trapped by those flashy news headlines. The stark contrast here is just incredible. On one hand, we see retail investors reacting emotionally to the pain at the pump. They see $5 gas, they watch the evening news, and what do? They buy energy titan stocks like Exxon or Chevron right at the absolute peak of the headline volatility. But on the other side, professional desks are doing the exact opposite. They are shorting the spread and dynamically managing complex options metrics like gamma and convexity. So retail investors basically end up unwittingly serving as exit liquidity for institutions who are already busy rotating their capital into safer, defensive long-term assets. Because institutions know the statistical half-life of a geopolitical panic. Historical modeling shows these spikes only last an average of 12 to 18 trading days before decaying. That means those who buy the top out of sheer fear get decimated by the inevitable mean reversion. The moment, the literal second, there is even a rumor of a fragile ceasefire or a diplomatic lull, the war risk premium evaporates, leading to an immediate 10 to 15% crash in the price of crude. In this game, timing is literally everything. All right, final piece of the puzzle. Section 6, Professional Derivative Strategies. Let's look at the exact tools the alpha generators are using to trade this environment safely. If you are trading the futures market, instrument selection is absolutely critical. The professional desks overwhelmingly favor the Brent contract, that's ticker/BZ, over the WTI contract, ticker/CL. Now, why is that? Well, because WTI has physical delivery risk at the Cushing hub in Oklahoma. You can have a massive global shortage, but if Cushing gets bottlenecked, WTI prices can decouple or even drop. Actually, by choosing cash-settled Brent futures, professionals isolate pure Hormuz transit risk without having to worry for a second about domestic pipeline logistics. And rather than guessing the outcome of the war, professional desks use algorithmic statistical arbitrage. They deploy mean reversion dynamics, setting automatic Bollinger Band triggers at 2 standard deviations above or below the historical mean. Think of these bands as an elastic safety net for a highly emotional market. While things like dynamic Kalman filter hedge ratios are also at play in the deep background, the core concept is pretty simple. When the price of gasoline or crude stretches way, way beyond that normal mathematical band due to sheer panic, the algorithms trigger automatic sell signals. It's not about predicting the next missile strike, it's about systematically exploiting short-term pricing inefficiencies. Take a look at this quote, because it perfectly summarizes the macroeconomic ripple effect here. The global economy is fundamentally shifting. We are moving away from an era of hyper-efficient, just-in-time logistics, where we all just assumed the seas would always be open and safe. The new reality is a multipolar world where structural redundancy and energy sovereignty dictate the price. Countries and giant corporations are now willing to pay a massive premium simply to guarantee that their energy and supply chains are resilient. So, leave the $5 gas complaints to the mainstream media. The structural changes in global logistics, the massive WTI Brent spread blowouts, and the new era of energy sovereignty have completely rewritten the rules of the market. So as you look at your own strategies, you really need to ask yourself, in this new high-premium energy reality, are you going to keep reacting to the news cycle, or are you positioned to actually harvest the alpha beneath the surface? Thank you so much for joining me for this explainer, and I'll see you in the next one.